treat you better, all these other bitches lazy. If you didn't know.
Oh, good afternoon to our friends on the East Coast, and good morning to our friends on the West. Hey, you know it's time it is. It's Wednesday, and it's time for the World on Finance with your favorite tax advisor, Mr. Everett James. Hey,
Yes, good morning. Can you hear me okay?
oh, loud and clear, my friend. Got a
Thank you.
question before you get started.
Okay.
Uh, I look at the market is topsy turvy, up and down, day to day. There is no confidence in the market. It doesn't seem like as much as in the past. How much do you think that the tariffs are impacting not only the economic future but also the stabilization of our market?
Yes, there's no question about it. And that's the one big gamble that our current leader, President Donald Trump, is taking. um, but we have to give it a chance to see what improvements that it may make in the marketplace, particularly the interest rate.
Okay. And not only that, my last thing, and I'm going to step aside
Yeah.
because I'm anxious to hear what you have to say. Well, not only the stock market, but the farmers, a lot of farmers are going bankrupt. They're losing their farms. The American car manufacturers, they're talking about billions. I'm talking about tens of billions of dollars that they lost this last quarter.
Uh-huh.
So I understand, some people, well, let's give it a chance, but Americans are hurting right now. People are losing their jobs. So, ah, I'm anxious to see what you have to say about this. So,
Yes, yes. Okay, but we'll probably cover that in more depth next week.
okay.
The This morning, however, I do need to just advise and put all of our listeners on the alert because of all of the changes that have taken place. From that one big beautiful bill,
Yeah. Okay.
uh, and we will. Certainly review that this morning. I think that it might be appropriate to just review some of the major changes and advise all of our listeners who are taxpayers that, believe it or not, October 15th, the deadline for those who have extended their filing of their 2024 tax return.
Yes.
That's coming up. We only have approximately approximately another little bit over a month, maybe kind of close just under 6 weeks before that deadline of October 16th arrives. So contact your tax professional or tax practitioner to make certain that you get your 2024 extended tax return in on time.
Okay.
There have been
Yeah,
so
I'll
many.
definitely be talking to my tax advisor here. Okay, I'm gonna
Yes,
let me step aside. All right, Ev.
that is so true. That is so true. The First, what is the current Department of Internal Revenue Service? What are some of the things that they are facing now that they have to implement that one big beautiful bill that got passed July 4th? Well, those that bill, included over 100 sections in 800 plus pages. The new law makes the tax code a lot more complex, and I'm certainly it's going to increase the need for you to stay close in touch with your tax practitioners and tax preparers. The the tax code is so much more complex since then. The Most of the tax changes are permanent. Well, there are some new tax breaks for individuals that are temporary. The changes have different effective dates. Many take effect this year. others kick in next year. Lots of new tax breaks have, keep in mind, have income limit thresholds. And that's so that the folks who are part of the upper income group will not benefit from them. And then there's the expiration date for all of the clean energy credits, from the that were passed, under the Biden administration. So, and now it's time for IRS to implement all those changes, and that's going to be a absolutely Herculean task for an agency that by September 30th of this year, 6 weeks, approximately, actually, yes, 6 weeks from now, that agency expected to lose 25% of its total workforce, mostly through voluntary deferred resignation programs and others versus layoffs. A lot of workers who took the deferred resignation offers are at or near retirement age. There's also been a lot of turmoil at the executive level within the agency. IRS now has a Senate-approved commissioner in former Congressman Billy Long, but that's after going through 5 other bosses since January 1st. So there's lots of high-level IRS officials have already left or are soon leaving the agency, including its chief information officer. So IRS does have a lot on its plate to implement the One Big Beautiful Bill. They'll have to revise forms, revise the instructions, rewrite the publications, and do it quickly, since many of the changes take effect for the 2025 returns that will be filed early next year. Several of the new tax changes have complicated rules and guardrails that will require IRS guidance to interpret. So we expect IRS at first issue lots of facts, fact sheets, and lots of explanations in Q&A format. More guidance, such as the revenue procedures and regulations, will come later. IRS's internet people have to reprogram the computer systems to account for all of the changes. So although this is a massive undertaking, the hopes are the agency will step up. Passing that the old BBB, the One Big Beautiful Bill, was a White House priority, and President Trump's administration will pressure the Department of Treasury and pressure IRS for a seamless implementation process. There will be a lot of hiccups. For example, next year's filing season will be delayed. IRS is planning to start the 2026 filing season really about a month late, right around President's Day, which is that will be around February 22nd of next year, 2026. And that's really about 3 weeks later than normal. The last time the filing season began in February was back in 2021. That's that we'll have to see if we do better this year. A lot of taxpayers and tax preparers will have questions on how this new bill applies in a wide range of scenarios, even if IRS is able to issue necessary timely guidance. But for folks, don't look for a lot of live assistance from IRS. The Taxpayer Service Group has been cut along with the rest of IRS. It's expected to be down 9,000 workers. It would be nice if IRS hires temporary workers for its toll-free telephone lines and properly trains them on the new tax provisions. But that's a little bit unlikely to happen. Yes, there will be folks answering the phones, but boy, expect to have a long wait. Getting answers to your tax, you know, uh, information and tax questions. That's maybe getting the complete answers in a substantial way may be a little bit of a pipe dream. Okay, before we go further, let me identify myself. This is Everett James, tax practitioner for over 50 years, coming to you every week on Wednesday, 10 a.m. on the West Coast, 1 p.m. on the East Coast. We will make every effort to respond to your inquiries and to your comments. And please feel free to take part in this weekly program. We can be reached by calling 951-522-9877. That is 951-522-9877. Or by email, evjtax1@gmail.com. That's evjtax1@gmail.com. The one is not spelled out, just the numeral. So we'll make every effort to answer any inquiries in the following week's program. So, first off, these changes will really be a huge magnitude. How does it affect Social Security? Well, the federal income taxation of Social Security really has not changed under that OBBB, the one big beautiful bill that got signed by President Trump on July 4th. Trump had promised to make the benefits fully tax-free, but there were not many people, particularly folks who work in the tax preparation business, who really felt that would actually come to fruition, primarily because the Social Security benefits that really do represent a huge outlay of government funds, and it almost has to be tied to some income coming back to the government through in the form of Social Security tax, in order to help balance the budget, if that is even possible. What are some of the rules on taxing your Social Security benefits? Well, some people are not taxed on their benefits at all. This includes individuals for whom Social Security is the sole or the primary source of gross income. Now, many others who receive Social Security benefits could owe a tax on ordinary rates of up to 50 to 85% of Social Security benefits, depending on the amount of their other income. Their other income has been entitled provisional income. What is provisional income? That is generally the combined total of all your tax-exempt interest plus 50% of your Social Security benefits, plus other non-Social Security income items that make up your adjusted gross income. And that's minus certain deductions and exclusions. A lot of Social Security recipients have their monthly Part B Medicare premiums paid from their Social Security benefits, thus lowering the actual amount of cash that they receive each month. To calculate the amount of Social Security benefits for federal income tax purposes, taxpayers should use the amount prior to the reduction for the reduction for Medicare premiums. So basically, you should show the total amount you received without reducing the amount that is considered to be payment for Medicare premiums. That number can be found in box 5 of Form SSA 1099 that recipients receive. For single filers, if provisional income is less than $25,000, then the benefits are tax-free. How about that? If that provisional income is between $25,000 and $34,000, up to 50% of the benefits are taxable. If provisional income is over $34,000, up to $85,000, up to 85% is taxed. For joint filers, if the provisional income is less than $32,000, this is for joint married filers. If the provisional income is less than $32,000, then the benefits are tax-free. If, however, for joint filers, the provisional income is between $32,000 and $44,000, then up to half of the benefits is taxable. If the provisional income for joint filers is over $44,000, up to 85% is taxed. If you want federal income tax withheld from your Social Security benefits, you can complete a Form W-4V to have some of your benefits taken out. Most states exempt Social Security benefits from state income tax, but not all. Now the outliers that tax all or part of the benefits are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. But many of these have exceptions based on the income figures. Okay, folks, I want to let you know that for anybody who is a resident of Virginia, here, listen up, you may be getting a rebate check. Well, given a historic, gubernatorial race, tax policy will remain a key issue for Virginians, in the month ahead. That Virginia will again offer they will again offer one-time tax rebates to residents in 2025. This continues the Commonwealth's practice of returning surplus funds directly to taxpayers as a form of financial relief. During a presentation regarding the 2025 budget, Virginia Governor Glenn Youngkin, I hope I'm pronouncing that right, Glenn Youngkin, said of the fiscal health of Virginia, "My friends, there is no reason to raise taxes on Virginia residents. We're running surplus after surplus after surplus." So the move is aligned with a trend where many states send residents stimulus checks and tax rebate payments. However, this year rebates come amid concerns across the country about inflation, tariff, and of course the rising cost of living. Alongside the rebates, several other key changes are taking effect this year in the Commonwealth, making 2025 a significant year for Virginia taxpayers. So it is that rebate program is designed to provide direct relief to Virginians who had a state income tax liability for the 2024 tax year. To be eligible, the taxpayers must file the Virginia state income tax returns by November 3rd of 2025 of this year. The rebate amounts are set to be up to $200 for single filers and up to $400 for married couples filing joint. However, the rebate cannot exceed the taxpayer's actual state tax liability after all deductions and credits are applied. For example, if a single filer owes $150 in Virginia income tax, their rebate will be limited to that amount rather than the full $200. So the payments will likely to begin to be distributed in were set up to be distributed to begin this past July, and they'll continue to be issued through mid-October of this year. And many of, according to this news blast, many of you may have already received a rebate. The Commonwealth typically issues payments via direct deposit for taxpayers who have previously set up this direct deposit arrangement. The Virginia Department of Taxation will offer additional information on this rebate website. So Virginia has also put safeguards in place to address outstanding debts owed to state agencies. That is not something that is something that possible recipients want to hear. But there is a set-off debt collection act. Any rebate owed to a taxpayer with outstanding state debt could be hit with that debt first. So if your debts exceed that rebate amount, you'll receive a notice explaining how that rebate was allocated. One of the most notable adjustments in the Virginia tax structure is the standard Virginia standard deduction. For the tax years beginning January 1st through December 2026, the standard deduction gets increased to $87.50 for single filers and $17,500 for married couples filing joint. And Virginia is also increasing its EITC, the Earned Income Tax Credit. The refundable portion of that is being increased. For self-employed individuals, freelancers, small business owners, the threshold in Virginia for making estimated tax payments will increase from $150 to $1,000 starting with tax year 2025. The Virginia will continue its annual sales holiday from August 1st to August 3rd this year. Shoppers can purchase school supplies, clothing, and certain energy-efficient products without paying any sales tax. So the tax policies, have really changed a great deal. Governor Youngkin, who's ineligible to run for re-election due to the Virginia prohibition on consecutive gubernatorial terms, has emphasized tax relief as a central theme of his administration. So it's the car tax that you folks all in Virginia have to deal with. It's been in place since 1782, remains a significant revenue source for local governments, funding schools, public safety, and other essential services. Local governments do assess a car tax annually. Vehicle owners receive a bill from their locality and they pay the tax directly to the local government, typically twice a year in May and October. So if you haven't already and are otherwise eligible, make sure your 2024 state income tax returns are filed by the November 3rd deadline to qualify for the tax rebate. Okay, so enough with Virginians, and we'll move on to general tax issues. The victims of disaster continue to get tax relief from Congress. In easing ups are found in the One Big Beautiful Bill and in the Filing Relief for Natural Disasters Act. Congress passed both of these bills in July, and the president signed them. So let's briefly review the three brand new tax changes for disaster victims. The first one is individuals can generally deduct losses from state declared disasters on their Forms 1040 in the same manner as losses from federally declared disasters. The second, a new tax change for disaster victims is filers can claim losses from some 2025 disasters even if they do not itemize. They're able to deduct uninsured personal losses in excess of a $500 threshold without regard to the 10% of adjusted gross income offset that generally applies. So this easing up is similar to prior relief for victims of disasters that occurred in 2020 through 2024. But it applies to disasters that began on or before July 4th of 2025. So if you suffered a loss in one of these federally declared disasters in 2025, you can apply the rules on your 2024 tax return or on your 2025 tax form. If you've already filed your 2024 tax return, you can amend it if it will help. Tax extensions after a disaster will be quicker these days. Okay, how about some information on partnerships and S corporations? They will need to file Schedule K2 and K3, but fewer of those partnerships and S corporations will need to file those particular forms. The new schedules give greater clarity to partners and S corporation owners on how to compute their U.S. income tax liability with respect to foreign tax credits, income from U.S. sources, but there is an exception for a lot of domestic entities. Partnerships with no or limited foreign activity and no foreign partners are exempt from the K2 and the K3 rules, as are S corporations with no or limited foreign activity. IRS has now offered more relief. Partnerships with total receipts under $250,000 and total assets under $1 million, and S corps with total receipts under $250,000 and total assets of less than $250,000 do not need to file those Schedule K2s or K3s. I've had this question come up frequently because so many of the special benefits and the improvements in the tax law define your benefit based on what is your modified adjusted gross income. The answer is somewhat tricky. IRS and other agencies use modified AGIs or modified adjusted gross income to determine their eligibility for certain benefits or to figure whether you are subject to surtaxes or to surcharges. For example, it's used in figuring income thresholds for popular tax credits, such as the Child Tax Credit, American Opportunity Tax Credit, and the Adoption Credit. If you'll excuse me for a second, hold on while I cut back this background noise. Thank you for the interruption, folks. But getting back to the modified adjusted gross income or just the adjusted gross income, it's used in figuring the income thresholds for popular tax credits, as I mentioned before. Such as the Child Tax Credit, the American Opportunity Tax Credit, and the Adoption Credit. It does determine those adjusted gross income and modified adjusted gross income do determine whether you're hit with a 3.8 tax on net investment income and whether you can still deduct student loan interest. For purposes of Medicare, it dictates whether you owe monthly premium surcharges for Medicare Part B and D. And it also determines if you're eligible to claim the following new tax deductions in the One Big Beautiful Bill. That's the up to the 40,000 state and local tax deduction on Schedule A, the deduction for qualified tips, the deduction for overtime pay, and the deduction for interest paid on vehicle loans. Plus, determines whether you can get the benefit of that bonus deduction for folks who are seniors, who are 65 years of age or older. Keep in mind that the higher SALT deduction, that is the $40,000 deduction for Schedule A, that is only for folks who itemize on Schedule A. The other four One Big Beautiful Bill write-offs, which itemizers or filers taking standing deduction can claim, are called below the line. Those are deductions, as I say, below the line that will benefit and can be used by both people who file, who take a standing deduction, and those who itemize. Just keep that in mind. The definition of the modified adjusted gross income different depending on what it's used for. I'd advise that if you are in this situation where there could be additional limitations, contact your tax preparer or your CPA for clarification. House appropriators, just to let you know, want to continue to cut IRS's annual funding, and by a lot. Does that have something to do with the Republican control of the House and the Senate? Well, possibly. Their proposal would cut their IRS's 2026 budget by $2.8 billion. That would be a 23% decrease from 2025, with IRS's enforcement arm taking the biggest hit with a 25% drop. The cuts are even higher than really what the White House has asked for. Trump has dangled the idea again of making all gain on home sales tax-free. Well, this might sound wonderful, but it's likely not going to really come to fruition anytime soon. There's just too much that would be giving away too much tax income, tax income to the federal government that they rely on in helping them to try to balance the budget. Under present law, if you have owned and lived in your main home for at least 2 of the 5 years before the sale date, let me repeat that. If you have owned and lived in your main home for at least 2 of the 5 years before the sale date, up to $250,000 of your gain or $500,000 for joint filers is tax-free. So if single folks get the exclusion of $250,000 and joint filers up to $500,000. Gain in excess of these amounts is taxed at the long-term capital gains rates. GOP folks advocate making the full gain tax-free. House Representative Marjorie Taylor Greene, a Republican from Georgia, she's introduced a bill to end that tax on sales of primary homes, saying her bill would lead to increased housing supply. Wow, that that does sound like a likely possibility. We certainly need the housing supply for all of the homeless issues that we are, you know, really suffering from in the United States. So keep in mind that if you're single and you sell at the current time, you can exclude up to $250,000 of your gain if you're single. If you're married, you can exclude up to $500,000 or $500,000 if you file jointly. And keep in mind that when you get a gain in excess of these amounts, that is taxed at long-term capital gains rates. So and one feasible option that may be studied by the Congress is just raising the current gain exclusion amounts, making it more than the $250,000 for singles and $500,000 for married couples. Another alternative is annually indexing those exclusion amounts to account for inflation. The $250,000 and $500,000 exclusion figures really have never been adjusted for the appreciation in residential real estate during the 28 years this popular tax break has been in effect. So, folks, as you can see, Congress is now in this months-long recess after passing the so-called one big beautiful bill. When taxpayers return to D.C. in early September, they'll have a lot of things on their to-do list. For example, working on avoiding a government shutdown after September 30th. That's going to be, we're looking at only 6 weeks off, approximately 6 weeks off when the government comes up to that deadline, to the fiscal deadline, and September 30th being the end of the fiscal year. A lot of hurdles are out there that have to be cleared for Congress to reach a deal. Republicans and Democrats are still very much divided. A lot of inter-party bickering among GOPers. Lots of friction, from the push by the White House to claw back money previously approved by Congress. In July, Republicans agreed to rescind $9 billion in previously approved spending. Trump wants Congress to okay a second bill, rescinding even more funding, although we don't yet know the details. Democrats are fuming over these rescission bills and are questioning whether they should cooperate with their GOP colleagues on government funding if Congress is just going to later renege and rescind the money. Now, there is a chance the federal government could close October 1. Odds are better that, however, that the parties will reach a short-term extension pact that would last maybe 30 days and expect this fight to continue throughout the fall. If there is a shutdown, we think IRS will keep some employees working to implement this one big beautiful bill that just got passed July 4th. And that, of course, kicks in for the 2025 tax returns filed early next year in February. Pulling off another reconciliation bill this fall is something GOP leaders and Trump would like to see happen, but the odds are that accomplishing this are really quite low. Items that could be included in any such bill are further cuts to Medicaid and other provisions that were in the House's version of the One Big Beautiful Bill, but were cut by the Senate parliamentarian because they supposedly violated procedural rules. Extending those expansions to the premium tax credit is a priority of Democrats. The premium tax credit is an Obamacare subsidy for eligible individuals who buy insurance through the marketplace. Most folks who qualify opt for the premium tax credit to be paid in advance directly to the health insurance company to lower their monthly premium payments. During the height of the COVID-19 pandemic, federal lawmakers enhanced the premium tax credit, letting more people qualify and increasing the credit amount. And of course, when they enhanced that premium tax credit, there are some who feel that that was a time when too many folks who were not citizens of the country somehow got benefits through this program, even though they're not citizens. But those expansions were temporary, ending at the end of 2025. Letting these expansions lapse will impact people seeking coverage for 2026 and later years and could cause millions of folks to lose insurance. But don't be surprised if Democrats use this as a negotiating tool. There's a willingness among some Republicans on Capitol Hill to make a deal with Democrats on this issue. But of course, that involves extending Medicaid benefits to folks who do not have citizenship and are still considered as illegal immigrants to be not entitled to the benefits of Medicaid. And this reporter will be exploring some of those issues with placing illegal immigrants on Medicaid rolls. Many states have, particularly those under the control of the Democratic Party, have extended the benefits of Medicaid to cover folks who are technically not citizens. But I believe, just from observing the back and forth controversy, that there probably will be some concessions made by the Republican Party for folks who are not citizens to get some type of Medicaid coverage. If they're children, if they are disabled, or perhaps are seniors, and only create the rule against extending the benefits to illegal immigrants, to just limit that to just persons who are able-bodied individuals who can work and are working and are in the labor market, and just create a exemption for folks who are in the immigrant status, for folks who are children, folks who are disabled, and folks who are seniors. The There will be some technical corrections to the One Big Beautiful Bill. It might happen later this year. That bill was enacted at what they call warp speed, with Trump signing that massive legislation on July 4th, less than 2 months after the bill was just first introduced in the House. It's no surprise that it has some slip-ups, snafus, and drafting mistakes that were unintended by the tax writers. Republicans may try to fix any errors by something called technical corrections. They may also address an old BBB provision that makes less gambling losses deductible. So I believe that prospective provision is going to limit the loss to just 90%, to figure this 90% of your gambling losses, as opposed to 100% of the gambling losses. Anyway, we'll have to see what happens with that area of the tax law. For folks who have student loans, 2025, has already been set up to be the last year for an income easing up on forgiven student loan debt. Most student loan debt, including parents plus loans forgiven in 2021 through 2025, is technically tax-free for income tax purposes. This relief, which was enacted in 2021, is an exception to the general rule. What's the general rule? General rule is that income from the cancellation of indebtedness is taxable. The One Big Beautiful Bill, which includes lots of non-tax changes to student loans, does not really extend that relief. So keep in mind that if you do have a college loan, it's going to become, after 2025, it's going to revert to being taxable again. There is a reminder that you might be aware of on employer-paid education assistance programs from IRS. The payments are tax-free to employees up to a limited amount. These plans allow employees to exclude from gross income and wages up to $5,250 of payments they receive each year for educational assistance benefits. The education does not have to be work-related. The plans must be written and meet other rules to qualify. So beginning next year, that $5,250 figure, that will be indexed annually, and it's going to be indexed to inflation. What are some of the items included in the qualifying educational benefits? Tuition, fees, books, supplies for college or graduate school. And keep in mind they include graduate school. Also, the plan can help employees pay off debt on their qualified educational loans. The student loan repayment feature was set to expire at the end of this year, but the OBBB, the One Big Beautiful Bill, permanently extended that break. There is a bipartisan bill that is helping small nonprofits offer retirement plans. That proposal, which was introduced in the House and Senate, that would extend to nonprofit certain startup credits for setting up retirement plans that are now available only to smaller for-profit employers. If that bill is enacted, eligible exempt groups would spend money to launch employee retirement plans, and they would be able to use up to $5,000 in tax credits to offset their payroll taxes. Okay, folks, who out in the listening audience is reaching age 73? That's called the retirement minimum distribution age. If you reach 73 years old this year, You are going to be hit with a required minimum distribution tax. And if you reach, and it applies to folks who reach 73 this year, in past years, it also applied, but if you're reaching 73 this year, your first retirement minimum distribution, RMD, is due by April 1st of next year. And that would be based on your account balance as of 12/31/2024. I'm so sorry. That's that would be based on your account balance. If you reach the sorry, this is 2025. Your second required minimum distribution would be due on December 31st of next year, based on your account as of 12/31 of this year. So keep in mind if any folks in the listening audience are going to be hitting age 73 this year, they call that the requirement minimum distribution age, you're going to be due to receive your first required minimum distribution by April 1st of next year. And that will be based, as I mentioned, based on your account balance as of the end of 2024. Your second required minimum distribution, which would be due at the end of 12/31/26, based on your account balance as of the end of this year. If there's any confusion on that, because it is sort of a confusion area, please contact your tax advisor for clarification. Okay, if you are of a required minimum distribution age, and you do have for example, a traditional IRA or a Roth IRA, keep in mind that you have to take your annual required minimum distribution before doing any conversion for the year. This applies whether or not you decide to convert the full IRA or just some of the funds. We received a question from a reader and listener as to how this rule works for IRA owners who turn 73 this year and decide to delay their first requirement distribution as late as April 1st of 2026. Really, in this situation, the IRA owner really cannot do our Roth conversion this year. He or she will instead have to wait until 2026 after taking the required minimum distribution for 2025 and 2026. Alternatively, the IRA owner can take the required minimum distribution in 2025 and then do the conversion, but you have to take that required minimum distribution before any type of conversion is completed. Okay, some things that really bear repeating, particularly if you're looking forward to filing your 2025 tax return, really this next year in 2026. Keep in mind the requirements covering donations. Bear in mind the substantiation rules to nail down your charitable contributions. These include some of the things you need to do. Keep all of your canceled checks, particularly those checks that were made out to charitable organizations. Keep receipts from making electronic funds transfers. Keep your credit card statements, or keep the letters from a charity when you actually make the cash donation. Again, keep your canceled checks. Keep the receipts from electronic funds that you transfer. Keep the credit card statements, and keep the letters, particularly from charities, when you actually make those donations. A letter or receipt from the charity will suffice for property donations under $250. So again, if the donation is under $250, you can just keep the letter or receipt. If you do make a donation that's valued over $250, you need a letter or receipt from the charity that will suffice for property donations. A letter or receipt will suffice for donations under $250. However, if it's over $250, keep a letter from the charity that you've made it to. Also, you have to keep a contemporaneous written acknowledgement from the donee, from the charitable organization, for cash or properties or gifts of $250 or more. So keep in mind that you have to get that written acknowledgement if that donation is for cash and this for cash over of $250 or more, or property that's valued of over $250. And you have to file a Form 8283 for non-cash donations over $500. Plus, you must have a written appraisal for property gifts valued over $5,000. That's one that gets missed a lot. And folks, when they are in a position to make that kind of a donation and it's valued over $5,000, somehow they feel that they can just get the letter from the organization that donation is made to without getting that written appraisal. If it's over $5,000, you don't have that appraisal, you're going to lose the deduction. Failing to strictly comply to this can cost you the entire write-off, which is showing up in this case. A man took a $6,760 charitable donation on a Schedule A for donations of property. Well, he attached the 8283. He listed the charity and a description of the donated items, but he did not include the dates of the donation and, most importantly, the value of those items. The tax court found those errors fatal and eliminated that deduction. Wow. Okay, if we have anybody in the listening audience who has received proceeds from for damages or settlement proceeds, keep in mind that the amount that you receive for physical injuries or physical illnesses are non-taxable. Again, the amounts you receive for physical injuries or physical illnesses are not taxable. However, you can get a deduction for just a narrow situations. You do get a exclusion if the amounts that you receive are for physical injuries or physical illnesses. Those are non-taxable. However, compensation for emotional distress is generally taxable. Now, if you do get one for emotional distress, there are two very, very narrow exceptions. Amounts paid for mental distress or anguish that arises from physical injuries are tax-free. And the same applies to reimbursements for medical treatment of emotional trauma. So keep in mind that those type of damages have some very, very strict rules, and best you consult your tax preparer or a tax consultant if you do fit into that category of receiving damages, and are hoping to treat those damages as non-taxable. Okay, if your settlement that you receive is taxable, if the settlement is taxable, you're generally taxed on the gross award, and that's without reduction for attorney fees. Say the lawyer who represents you in a case in which you're awarded $200,000. You receive the money and then deduct $60,000 in attorney fees, and you get the check for $140,000. Unfortunately, that full $200,000 is taxable to you. You generally cannot deduct the attorney fees. Now, there are some very, very limited exceptions. For example, a taxpayer could deduct lawyer's fees on Schedule C if the underlying case was related to his or her business. Also, a plaintiff who receives damages or proceeds in connection with an action involving a claim of unlawful discrimination can take a write-off for attorney fees, thanks to a federal tax law that gives plaintiffs in discrimination cases an above-the-line deduction for such costs. The tax court in in previous cases said that the woman might be able to deduct her lawyer's fees. So, either case is wise to consult a lawyer, not only your tax preparer, but also a lawyer, to be certain of being able to deduct that lawyer's fee legally. And then we'll be closing the program, and let you know that this reporter, Edward James, comes on Wednesday at 10 a.m. on the East Coast, 1 p.m. On the East Coast, and we can be reached by contacting us at 951-522-9877, or doing it by email, ebjtax1@gmail.com. Okay, looking forward to your questions and comments, and we'll see you next week.
All right. Hey, Ev, thank you so much. Great information. And guys, come back tonight. You don't want to miss this special episode of Cultural Excellence. I've got former music producer, Mr. Patrick Spencer. He's worked with people like Diana Ross, The Whispers, Lakeside, on and on and on, Shalimar, and lots of great information, lots of great music. So kick back, grab a glass, and enjoy. Ev, thanks, and we'll talk soon, my friend.
Thank you.